Welcome, welcome, welcome to the deep dive. Today, we're plunging headfirst into a world that's, well, buzzing with excitement, confusion, and yeah, a whole lot of potential: cryptocurrency investing.
hmm
It can feel incredibly intimidating, right? You hear about those incredible gains, you see the headlines, and perhaps you've even felt that subtle nagging pull, that feeling of being overwhelmed, or maybe that undeniable urge of missing out on something truly big.
Yeah, that FOMO feeling is real.
Exactly. So let's really unpack this. Why do so many people, despite all the undeniable potential of crypto, seem to navigate it in a way that ultimately leads to losses?
That's the million-dollar question, isn't it?
It really is. Our mission today is to cut through all that noise, the relentless hype, and that often debilitating emotional roller coaster. We've done the heavy lifting for you, taking a deep dive into some truly insightful source material, a comprehensive study guide, some really powerful visual aids that lay bare market psychology, and some direct audio insights from experienced investors.
Right.
It's all designed to give you a shortcut to understanding the critical human element of crypto markets, the precise strategies that smart money investors use to counteract those very human tendencies, and all the essential practical considerations, from navigating taxes to securing your assets. This deep dive isn't just about cryptocurrency. It's really about understanding universal principles for navigating any volatile investment landscape.
And that's precisely what's so fascinating here. The core to achieving sustained success in this dynamic space isn't simply about understanding the underlying technology or trying to perfectly predict price movements, which, let's be honest, is a kind of a fool's errand.
Totally.
Instead, it's fundamentally about understanding ourselves and the collective behavior of the entire market. The material we've explored provides a crystal clear roadmap for how to think and, crucially, how to act, like those experienced smart money investors you often hear about, the ones who seem to consistently thrive amidst the chaos. Throughout this deep dive, we'll be covering critical areas, from the powerful psychology that drives market cycles, to the disciplined research methods that cut through the noise, to robust long-term strategies, and finally, those absolutely crucial practical steps, like managing your tax obligations and securing your digital assets. It's all about building resilience and empowering you to make truly informed decisions.
That resilience you mentioned is key. And when we talk about navigating volatile markets, the first and perhaps most potent psychological trap that springs to mind for anyone who's even dipped a toe into crypto is that powerful, almost primal feeling of FOMO, fear of missing out.
Oh yeah, FOMO, big one.
Here's where it gets really interesting, because FOMO isn't just a catchy acronym. It's a profound, almost unavoidable psychological phenomenon that, according to our sources, tragically drives the behavior of most retail investors.
Most investors.
It's this irresistible urge that often leads people to jump into the market at the absolute worst possible time, when the asset is at its peak, when everyone's talking about it on social media, and when prices have already surged way, way past their quiet, undervalued accumulation stages.
Right at the top, usually.
Think about it. You're scrolling through your feed, you see a coin skyrocketing, a friend casually mentions they just made a huge gain on it, and suddenly, you feel that intense pressure. You have to get in now, or you'll be left behind watching others get rich.
Yeah, that pressure is intense.
You convince yourself this time is different, that the parabolic rise will continue indefinitely. But what happens then, almost inevitably, you buy at the top, the market inevitably corrects, as all markets do, and those dizzying prices plummet.
And the feeling turns sour very quickly.
That initial excitement instantly turns into gnawing fear, then despair. Driven by emotion, you panic sell, often at a substantial loss, get completely discouraged, and might even swear off crypto investing forever just as the market begins to quietly, painlessly recover.
It's a classic pattern.
It's a vicious, self-perpetuating cycle, and it's heartbreakingly common.
And that very cycle is perfectly illustrated by what our sources term the crypto investment pyramid. Imagine a pyramid. At its very top, narrow and precarious, where there's scarcely room to stand, is euphoria.
Okay.
This, unequivocally, is the absolute worst time to buy into an asset. It's characterized by widespread, almost manic conversation, breathtakingly rapid price increases, and a pervasive, irrational sense that this can only go up forever.
Sounds familiar.
Beneath that, in the middle, lies fear. This is the stage when prices begin their inevitable plummet, and that widespread panic selling the host just described truly takes hold. People start offloading their assets en masse, often at a significant loss, driven purely by the emotional pain of seeing their gains or even their initial investment just evaporate.
Right, the panic sets in.
But then, at the broad, stable, and often overlooked base of this pyramid, we find disbelief. This is the quiet period, the market's doldrums. Prices are low, few people are even bothering to talk about crypto, and even fewer genuinely believe in a substantial recovery.
The boring part.
Exactly. Yet, time and again, our sources highlight this exact stage as the best time to invest. Why? Because this is precisely when smart money does the exact opposite of the emotional crowd.
They go against the grain.
They are buying during boredom, selling during excitement. It sounds deceptively simple, but think about the immense psychological hurdle involved. When everyone else is consumed by despair, selling off their assets, your natural primal instinct is to join them, to cut your losses.
Sure, it feels safer.
But smart money has trained themselves to see opportunity where others see only overwhelming risk. They're diligently accumulating undervalued assets precisely because the crowd has abandoned them, understanding that long-term foundational value often emerges from these prolonged periods of perceived boredom and neglect. This principle it's a fundamental cornerstone you'll hear reiterated throughout this deep dive.
That makes sense. Buy low, sell high, but actually doing it when your emotions scream otherwise.
Precisely. To truly expand on this, let's overlay this concept with the broader market psychology cycle, a circular model that vividly shows how these powerful human emotions play out over time, driving market behavior in predictable patterns.
Okay, so it's a cycle.
It starts, perhaps counterintuitively, with depression and disbelief. At this point, prices are typically at their absolute lows, and a pervasive sense of hopelessness hangs over the market. Very few, if any, believe a recovery is even remotely possible.
Rock bottom.
This is the extended period when smart money truly begins their strategic accumulation, quietly building significant positions, while everyone else is despondent or has simply given up. They're not just buying, they're buying with deep conviction in the face of widespread pessimism.
While everyone else is running away.
Right. From this low point, the cycle gradually transitions into hope and optimism. You start to see the early nascent signs of recovery. A few brave early adopters return to the market, perhaps sensing a shift, and media coverage, initially sparse, slowly begins to trickle in, bringing back a faint sense of possibility.
A little glimmer.
This slowly builds into belief and euphoria, where rapid, often exhilarating, price increases take hold. This is the phase where FOMO truly explodes, drawing in swaths of new, inexperienced investors who see only the upward trajectory.
The party starts.
Excessive optimism becomes the prevailing sentiment, and everyone, it seems, feels like an investing genius. People start taking on more risk, assuming the good times will never end.
Uh-oh. Famous last words.
Indeed. Finally, as the cycle reaches its dizzying peak and begins its descent, it moves into anxiety and panic. Prices start falling slowly at first, then picking up speed. That widespread euphoria quickly curdles into apprehension, then outright fear, and finally unadulterated panic, leading to rapid, indiscriminate selling.
The crash.
The cycle then begins anew, eventually returning to depression and disbelief. This raises an important question for you, the listener, and it's one our sources repeatedly address. How do these emotional cycles repeat so consistently across virtually every market? And why do most investors, despite the wealth of information available, consistently fall victim to them, buying high and selling low?
Yeah, why don't we learn?
It's a testament to the power of collective human emotion over individual rationality. It's just incredibly hard to fight the crowd.
It's truly fascinating, and yes, a bit disheartening, how consistently human behavior plays out in these cycles, regardless of the asset class. Our sources elaborate on an even longer, more granular emotional journey, particularly descriptive of a bull run. The 12-stage emotional cycle.
Ah, yes, the full roller coaster.
It really paints the full, nuanced picture of this ride. It begins with disbelief. When the market has bottomed and things look bleak, most people simply can't imagine a rebound. Then, as early signs emerge, it moves to hope, followed by cautious optimism, and then genuine belief as prices slowly begin to recover and confidence tentatively builds.
Okay, the climb begins.
Then comes euphoria, that undeniable peak of excitement where everyone thinks they're a trading savant, convinced they've found the cheat code to infinite wealth. It's a dangerous place to be.
Extremely dangerous. Maximum risk, usually.
But then, the subtle, almost imperceptible shift begins with complacency, where people assume the good times will just keep rolling, often ignoring warning signs. This quietly leads into anxiety as the first real cracks in the market appear, perhaps a significant dip that feels unnerving.
The first doubts creep in.
This is quickly followed by denial. where investors refuse to believe the market is actually turning downwards, rationalizing every drop as a temporary blip. They might say, it's just a correction, it'll bounce back.
This time is different, right?
Exactly. Then the real pain sets in, panic, where people sell indiscriminately, leading to capitulation, where people just give up entirely, selling at massive losses, accepting defeat.
Throwing in the towel.
Followed by deep anger at themselves or the market, and finally profound depression when they've lost hope and often a significant portion of their capital. It's a progression that, once you see it, becomes almost painfully clear.
What's absolutely critical here, and a consistent theme across our source material, is that smart investors don't just know about this entire progression. They understand it deeply. They internalize that these are cycles, not linear, endless progressions upwards.
Right, they expect the downturn.
Armed with this understanding, they are actively accumulating during the bear market, those quieter, often painful stages near depression and disbelief, and strategically selling into the hype during the bull market, specifically as the market approaches euphoria and complacency.
Doing the opposite again.
This disciplined approach, which often means acting directly contrary to the emotional crowd, is their single greatest advantage. It's about recognizing the psychological peaks and troughs, detaching emotionally, and making purely rational decisions, not impulsive ones driven by fear or greed.
Rationality over emotion.
They're buying when there's blood in the streets, metaphorically speaking, and selling when everyone is cheering. It's simple in concept, incredibly hard in practice.
So, if understanding and counteracting our own emotions is the first major trap to skillfully avoid, then the next formidable beast to tackle in this crypto jungle is definitely cutting through the sheer volume of misinformation and outright hype that saturates the crypto space.
Oh, the hype is deafening sometimes.
I mean, you can't scroll through any social media platform, open YouTube, or even just casually browse crypto news sites without being absolutely bombarded by crypto influencers or what amounts to pure YouTube hype. It's an omnipresent, often misleading force.
It really is everywhere, constant noise.
So with all that noise, what does this all mean for you, the aspiring or current crypto investor? How do you even begin to discern genuine, valuable, actionable information from paid promotions or just plain old wild speculation?
That's the critical skill, isn't it? Filtering.
Our source material has some really straightforward yet profoundly powerful advice. Always ask, what's their motive? It cautions with stark clarity that many of these so-called influencers are just entertainers guessing. Or far worse, they're being handsomely paid to promote a specific coin, regardless of its underlying value or long-term viability.
Right. Are they informing or just selling?
It really is the Wild West out there, and you, the listener, need to be armed with a healthy, almost default level of skepticism. Don't trust, verify.
That's precisely where the critical concept of DYOR comes in. Do your own research. This isn't just a catchy acronym. It is your fundamental, non-negotiable antidote to the pervasive hype.
Okay, DYOR.
It's about taking full responsibility for your own investment decisions by performing diligent, independent investigation. Our sources break down this essential process into several actionable steps, starting with project analysis.
Right.
The golden rule here is to look at the project, not just the price. The price is merely a reflection of sentiment, maybe hype. The project's utility is its foundation.
What does it actually do?
Exactly. You need to ask fundamental questions. What specific real-world problem does this project genuinely solve? Is it creating tangible utility, or is it merely a speculative token hoping to catch a trend? Next, delve deeply into the team credibility.
Who's behind it?
Is the team public and credible? Do they have a verifiable track record, perhaps visible on platforms like LinkedIn, with past projects or relevant industry experience? Or are they entirely anonymous?
Is anonymous always bad?
Well, while some projects, particularly those focused on privacy, might choose anonymity for valid reasons for the vast majority, an anonymous team can be a significant red flag, as it offers little to no accountability if things go sideways.
Okay, that makes sense.
Furthermore, crucially, consider user adoption.
Yeah.
Are people actually using the product or service the project offers? Look for metrics like daily active users, transaction volume, or actual engagement beyond just a buzzing Telegram group. This is a strong indicator of real-world utility and organic demand, not just speculative interest.
So actual usage matters.
Immensely. When it comes to finding reliable sources for your research, always stick to the reputable ones, as highlighted in our study guide. It recommends platforms like CoinMarketCap and CoinGecko for aggregated market data, price charts, and high-level project overviews.
Good starting points.
But go deeper. Always check the project's official website and meticulously read their white paper. The white paper is paramount because it meticulously outlines the project's core vision, its underlying technology, its proposed solutions, and its future roadmap. It's essentially their business plan and technical blueprint.
The nitty-gritty details.
Yep. And for developers or those keen on the technical robustness, GitHub is vital for seeing actual development activity, code commits, and the health of the project's open source contributions. A project with a vibrant, active GitHub is a far better sign than one that's stagnant.
So it's not just about what the project says it will do, but about what it's actually doing, who's behind it, and if anyone's even using it. It reminds me of those early internet days where every new .com was a sure thing until you looked under the hood and found, well, not much.
Exactly the same principle. History repeats.
And it's not just about the project itself, is it? It's also about understanding the fundamental economics behind the token you're considering. It's like evaluating a company's financial statements before investing.
You've hit on a crucial point. The next critical step in your DYOR process is understanding tokenomics, the intricate economics of the cryptocurrency itself. This tells you how the token functions within its ecosystem and its long-term viability.
Tokenomics, okay.
You need to investigate the total coin supply.
Yeah.
How many coins exist in total? Is it a fixed supply, like Bitcoin, making it potentially deflationary by nature, or can more coins be minted, possibly making it inflationary? This has profound implications for long-term value.
Supply and demand, basically.
Then meticulously look at ownership distribution. Who owns how much of the total supply? If a disproportionately large percentage is held by a few early investors, the project team, or venture capitalists, that can be a significant risk.
Why is that risky?
This concentration of power means that a few individuals or entities could, with a single decision, flood the market with their tokens, causing a sudden and severe price crash that disproportionately harms smaller, retail investors. It's like a company where the founders still own 90% of the shares, great for them, but a big risk if they decide to sell a huge chunk all at once.
Got it. Too much control in few hands.
You also need to consider its inflationary versus deflationary nature. Does the supply naturally increase over time, which can dilute the value of existing coins? Or does it decrease through mechanisms like token burning, which could potentially make it more scarce and valuable over time?
So does the pie get bigger or smaller?
Right. Finally, and this is a particularly big one, understand the unlock schedule for early investors in the team.
Well,
When do large amounts of coins become available to initial investors, advisors, or the core team members?
the vesting schedule.
Exactly. If not managed properly with vesting schedules, these unlocks can lead to massive dumps on retail investors, driving the price down sharply as early holders cash out. Our sources are very clear and emphatic on this. Projects with bad tokenomics dump on retail investors. Avoid those. This is a powerful, almost unavoidable warning signal.
That distinction makes so much sense. It's like knowing if the business you're investing in has a solid, sustainable financial model, not just a flashy advertising campaign and grand promises.
Precisely. Substance over hype.
And speaking of red flags, what are some of the absolute concrete warnings that should make a listener pause, take a deep breath, and seriously reconsider an investment? Because the crypto space, while brimming with innovation, can also be a perilous minefield for scams and projects designed to enrich only a select few.
Absolutely. Our source material provides a very clear and actionable list of red flags to watch for. First, be extremely wary if there's no public team info or transparent identification for the project.
The anonymous team again?
While privacy is valued in crypto, a completely anonymous team, especially for a new or unproven project, vastly increases your personal risk. It's an accountability vacuum. Second, be hyper-skeptical of unrealistic promises or guarantees of returns. Any project promising guaranteed 100x returns or that you'll be rich overnight.
Yeah, if it sounds too good to be true.
It almost certainly is. True innovation takes time and comes with risk. Third, scrutinize exceptionally high APY, annual percentage yield, staking offers without a clear, verifiable, and sustainable underlying product or revenue stream. How can they possibly pay out such exorbitant returns sustainably?
Where's the money coming from?
Often they can't. They're simply paying out earlier investors with later investors' money, the classic Ponzi scheme structure. Fourth, a very common and glaring red flag is no product, just hype.
All sizzle, no steak.
Exactly. No functioning decentralized application, DApp. No real-world use case or working technology. Just a lot of talk, aggressive marketing, and influencer promotions centered around a token. This is a strong indicator of a purely speculative play designed to enrich early investors at the expense of later, unsuspecting ones.
Okay.
Finally, be extremely cautious of Telegram groups or Discord servers filled with bots and spam. If the community engagement looks artificial, repetitive, or overwhelmingly low quality, it's a very bad sign. As our sources succinctly and powerfully put it, if it looks like a scam, it probably is. Trust your gut, do your homework, and always default to caution. Your capital depends on it.
That's some solid, actionable advice right there. Trust but verify, and if your gut screams scam, listen to it.
Okay, so we've covered skillfully avoiding the emotional traps and the absolute imperative of deep, rational, independent research. But beyond just avoiding pitfalls, what's the proactive, disciplined strategy for building lasting, sustainable success in this incredibly volatile market?
Right, moving from defense to offense, strategy-wise. Okay, let's truly unpack this. Our sources consistently emphasize and re-emphasize the profound concept of building a long-term mindset in crypto investing. They repeatedly point out that patience and unwavering discipline are not just abstract virtues, they are, in fact, your greatest advantages in this arena.
Patience and discipline.
In a market that moves with such dizzying speed that feels almost counterintuitive, doesn't it? To slow down, to be patient, when everything feels like a race.
It absolutely does feel counterintuitive, and that's precisely why adopting this mindset is so incredibly powerful and separates the smart money from the emotional crowd. A long-term mindset fundamentally helps you detach from the relentless daily noise, the incessant price fluctuations, and the ephemeral hype cycles, allowing you to focus squarely on the bigger, more impactful picture.
Seeing the forest, not just the trees.
Exactly. It all starts with setting investment goals. Before you commit a single dollar, you need to precisely define your why. Why are you buying this particular asset? What specific problem does it solve for you? What long-term vision or technological shift do you genuinely believe it will contribute to? This isn't just about making money. It's about aligning with a purpose.
Knowing your why.
Crucially, you must establish an exit price before you even buy. What's your predefined target for filling a portion or all of your holdings? This proactive step is vital. It prevents emotional holding when prices start to rise significantly, and it counters the urge to just let it ride indefinitely, potentially missing out on real gains.
Have exit plan.
And you also need to meticulously plan for potential price drops. Our sources ask directly, what will you do specifically if the asset you buy suddenly drops 50%? Are you emotionally and financially okay holding it for 3 to 5 years if necessary, waiting for its thesis to play out?
Can you stomach the downturn?
This foresight, this disciplined pre-planning is absolutely critical because, as the material wisely states, if you don't have a plan, you'll inevitably follow someone else's, and they might be completely wrong for your specific financial situation. This disciplined pre-planning is a hallmark of truly smart investing.
That's a total game changer for so many people who simply buy an asset and then hope for the best, reacting to every news headline. It's like setting sail into a stormy ocean without a map, a compass, or even a destination in mind.
Precisely. You need navigation tools.
And when we talk about discipline, there's one particular strategy that constantly comes up in our source material that seems almost tailor-made for navigating consistently volatile markets.
Indeed, and that's the elegantly simple yet incredibly effective strategy of dollar cost averaging.
DCA.
DCA.
Right.
This strategy is deceptively simple, but incredibly powerful at mitigating risk and reducing emotional decision-making. It means systematically buying small, regular amounts of an asset over time, regardless of its current price.
Like clockwork.
For example, our sources suggest a practical approach like buy $50 of ETH every 2 weeks, no matter the price. You commit to a consistent schedule and a fixed dollar amount, removing the need to predict market highs or lows.
Takes the timing guesswork out.
The benefits of DCA are substantial and profound. First, it reduces emotional decision-making. You're not trying to time the market, which is an inherently impossible task for anyone consistently. You're simply executing a predefined, disciplined plan.
Less stress.
This eliminates the stress of daily price checks and second-guessing. Second, it ingeniously helps you buy dips automatically. When the price goes down, your fixed dollar amount buys more coins, effectively averaging down your overall cost basis. When the price goes up, you still buy, maintaining your exposure and participating in the upside.
So you buy more when it's cheap, less when it's expensive automatically.
Exactly. This strategy completely removes the psychological burden and futility of trying to perfectly predict market movements, which is where most investors stumble. It's a long-term winner for consistent wealth building.
And once your investments are performing well, perhaps even showing significant gains, That's where another crucial strategy comes in, one that often goes directly against the popular crypto mantra of HODL forever, hold on for dear life.
Ah, HODL, a loaded term.
While HODL has its place, especially for assets you have deep, long-term conviction in, our sources clearly show it's not a universal strategy for all assets or for all stages of a bull run.
You're absolutely right. Our source material strongly advocates for the crucial practice of taking profits. While ODODL can be a valid strategy for truly foundational assets like Bitcoin or Ethereum over many years, it's not a blanket rule for everything or for every market cycle.
Because markets go down too.
As we've extensively discussed, the market moves in cycles. If you simply ODODL forever without ever realizing gains, you run the very real risk of seeing your paper profits evaporate entirely during an inevitable bear market, only to find yourself back at square one or even in a loss position.
Ouch, watching it all disappear.
It's critically important to take some profits during bull runs. This is where you strategically secure your hard-earned gains. A key strategy highlighted is to pull out your original investment.
De-risking.
Exactly.
Yeah.
For instance, once your investment has doubled, sell enough of the asset to fully recover your initial capital. From that point forward, the remaining portion of your holding is, in essence, free, reducing your risk on that specific asset to zero. You're playing with house money.
That's smart.
Our sources emphasize setting these sale targets well in advance. Don't wait for the absolute top because, as they sagely advise, nobody times it perfectly.
Trying to catch the very peak is impossible.
The emotional struggle here is immense. The fear of missing out on even more gains if the price keeps climbing, or the regret of selling too early. But the discipline of a predefined plan mitigates this. And perhaps the most impactful statement from the material, one that cuts through all the hype: profits aren't real until you sell.
Wow, yeah. Paper gains aren't cash in the bank.
This powerfully drives home the point that paper gains, no matter how impressive on your screen, are just that, paper gains, until they are actually realized and converted into stable currency or another asset.
That's such a powerful truth, not just for crypto, but for any investment, really. It's the kind of wisdom that truly separates the smart money investors from most investors who are constantly chasing pumps, reacting to every single news headline, and letting their emotions dictate their decisions.
Discipline makes the difference.
If we connect this to the bigger picture, these disciplined strategies, setting goals, dollar cost averaging, and smart profit taking are precisely what allow smart investors to navigate those intense emotional market cycles we discussed earlier. They don't just know about the cycles, they act strategically and dispassionately according to them, consistently buying during those quiet, often painful periods of disbelief and depression, and selling into the widespread excitement and euphoria. It's a complete reversal of the typical emotional impulse.
It really is acting against your gut instinct, often.
So now that you've got the right mindset, a solid, disciplined strategy, and an understanding of how to conduct thorough research, what about the practical side? What are the essential tools and crucial considerations to ensure not only long-term success, but perhaps most importantly, long-term safety and compliance in the crypto space?
Right, the practical nuts and bolts.
Let's bridge the gap from big picture strategy right down to the vital, actionable implementation details.
Exactly. Let's begin with market tracking tools. You don't need to be a full-time professional trader to benefit immensely from understanding the broader pulse of the market.
Tools to help see clearly.
Our source material recommends a particularly insightful tool, the Fear and Greed Index. This index doesn't just show you prices, it tells you the mood of the market, whether investors are predominantly fearful, which often signals a potential buying opportunity for the contrarian,
Buy when others are scared.
or overwhelmingly greedy, which might suggest a potential selling opportunity as the market becomes overextended. It's an invaluable sentiment indicator.
Sell when others are greedy. Got it.
For basic charts and price visualization, TradingView is highly recommended. It's user-friendly, and our sources explicitly state you don't need to be an expert to get significant value from it. It allows you to visualize price movements over time, identify trends, and set price alerts.
Just the basics can help a lot.
For those seeking deeper on-chain data, which means looking at the actual transactions and movements on the blockchain itself, Glassnode is mentioned as an optional, yet powerful tool.
On-chain data, what does that really tell you?
Well, we're talking about seeing granular details, like how much crypto is moving onto exchanges, which can be a signal for selling pressure, or how many new wallets are being created, maybe indicating new adoption, or even tracking large whale movements. It provides a more fundamental understanding of market flows beyond just speculative price action.
Okay, so it's looking under the hood of the network itself.
Pretty much. The general advice for using these tools is pragmatic and aligns with our long-term theme. Set alerts. Learn patterns over time, no rush. This reinforces the patient, methodical approach rather than impulsive trading.
Learn gradually, don't rush. Makes sense. Tools are undeniably helpful, but there's a crucial, often overlooked aspect of crypto ownership that can catch many new investors completely off guard, and that's taxes.
Ah, yes. The tax man cometh.
It's certainly not the most exciting topic, but it's absolutely vital for staying compliant and out of trouble, particularly as your portfolio grows.
It is absolutely critical, and yes, it's often overlooked until it's too late, leading to unnecessary stress and potential penalties. The fundamental point here is that crypto is taxed as property in most jurisdictions, including key markets like the United States.
As property, not currency. That's key.
This is a fundamental concept that differs significantly from how many people might initially think about it. The implication of this classification is profound. Every sale or trade can trigger tax implications.
Every single one, even crypto to crypto.
Yes. This isn't just about selling for a profit back to dollars. Even trading one cryptocurrency for another, say swapping Bitcoin for Ethereum, is typically considered a taxable event where you effectively sell one asset to acquire another. This can lead to capital gains or losses that need reporting.
Wow, okay, that's a lot to track.
Therefore, essential practices include needing to keep detailed records of all transactions throughout the entire year. This means meticulous tracking of every single purchase, every sale, every trade, even certain staking rewards, mining income, or airdrops. Trying to reconstruct this complex transaction history at tax time,
Nightmare.
often spanning hundreds or thousands of individual entries, is a monumental nightmare. The good news is that you don't have to do it all manually. Our sources highlight that you can use specialized crypto tax software to automate calculations and stay compliant.
Thank goodness for software.
These modern tools can connect directly to your various exchanges and wallets, helping to streamline the data aggregation and calculation process significantly. Reassuringly, our sources conclude this segment by stating, taxes don't have to be scary, but they unequivocally add that good habits and tools are vital for peace of mind and legal compliance. Ignoring this is not an option for any serious crypto investor.
Right. Get the right tools, keep good records from day one. And finally, perhaps the single most important safeguard of all is one that applies to all our digital lives, but takes on paramount importance when it comes to our valuable crypto assets. It's the bedrock upon which all your investment strategies must be built.
That's absolutely right, and it truly cannot be stressed enough. Security first.
Security, number one.
Our source material stresses the paramount importance of security, asserting that strong security habits are just as important as smart investment strategies. The purpose here is crystal clear and non-negotiable. It's about diligently protecting your hard-earned investments from the ever-present threats of hacks and scams.
Because if it's gone, it's gone.
Exactly. The immutable digital nature of cryptocurrency means that once it's stolen or sent to the wrong address, it's almost invariably gone forever, with no central authority to reverse the transaction. This isn't like a credit card chargeback.
And no safety net.
Our sources hint that the next logical step in learning involves understanding specific, essential security practices, emphasizing that this is an ongoing learning process, not a one-time setup. Concrete examples include using hardware wallets, those physical devices, to store your crypto offline.
Cold storage.
Enabling strong, unique passwords for every single account, always using two-factor authentication or 2FA, being meticulously wary of phishing links, and never ever sharing your private keys or seed phrases.
Never share the keys to the kingdom.
These are the defensive walls around your digital wealth. To reinforce the overarching message of this entire deep dive, remember what's powerfully stated in our material. Patience and discipline are the ultimate, enduring advantages in cryptocurrency investing.
Patience and discipline.
These two qualities, above all others, override the chaotic hype cycles, silence the emotional noise, and allow you to focus steadfastly on the fundamental value and long-term potential of the assets you choose. It's about being deliberate, strategic, and rational, not reactive or impulsive. It's about playing the long game with a clear head.
And there you have it. We've journeyed through the often tumultuous emotional landscape of crypto markets, learned how to identify and skillfully avoid the cunning traps of FOMO and pervasive hype, dissected the art of doing your own thorough, independent research, and laid out the disciplined path of a long-term mindset through invaluable strategies like dollar cost averaging and smart, systematic profit taking.
Covered a lot of ground.
And crucially, we covered those vital safeguards of tax compliance and robust digital security. Ultimately, this deep dive is about empowering you to make truly informed, disciplined, and resilient decisions, rather than simply getting swept away by the ever-shifting tides of the crowd.
What's truly fascinating here, and a point our sources subtly underscore, is how universal these principles are. While we've applied them specifically to crypto, this deep dive into understanding disbelief and euphoria and the distinct behaviors of smart money versus the emotional crowd reveals fundamental truths about human behavior in all financial markets, and frankly, far beyond.
It's human nature, really.
These patterns of collective excitement and despair aren't unique to digital assets. This raises an important question for you, the listener. If understanding the emotional cycle of markets, recognizing when others are in euphoria or despair, and acting against that instinct is key to successful crypto investing, how can this profound insight change how you approach other significant decisions in your life, especially when faced with collective excitement or widespread despair in other contexts?
Something to think about.
Keep asking those questions, keep learning, and most importantly, keep thinking critically.